Hey everyone, welcome back. We're about to get our hands dirty, metaphorically, of course, with a deep dive into a book that's all about smart investing.
Oh, are we talking about Thomas Bulkowski's fundamental analysis and position trading?
You got it. It's a bit of a mouthful, right?
Hmm.
But trust me, this book has some seriously insightful stuff about how companies tick.
It's not just for Wall Street gurus either. Even if you're just starting out, or even if you don't consider yourself an investor at all,
Exactly. There are some really valuable ideas in here about what makes businesses succeed.
which, let's face it, impacts all of us, right?
100%. So no matter what your level of experience is with the stock market, um,
Whether you're a seasoned trader or just curious about how it all works.
this deep dive is going to be worth your time. Okay, ready to jump in?
Let's do it.
All right, so Bulkowski's whole thing is about connecting the dots between a company's financial health, the fundamentals.
Right, like their earnings, their debt, their management team, all that good stuff. Yep. And then he ties that into the strategy of actually timing your moves in the market, what he calls position trading.
So it's about understanding the companies from the inside out,
Hmm.
but also knowing when to buy, when to sell, and how to ride those market waves.
It's almost like he's saying, don't just follow the hype, understand the engine, and know when to hit the gas.
I like that. He gives you the tools to be a smart investor, not just a
Mhm.
reactive one.
Okay, so one of the first things Bulkowski tackles is stock selection. Specifically, he looked at stocks that doubled in value, those elusive doublers.
Everybody wants to find those, right? The golden tickets?
Right. And get this, he found that the sweet spot for these doublers was typically priced between like $5 and $10 a share. So not necessarily the big flashy names everyone knows.
What's interesting is that he found smaller companies were actually more likely to be those doublers. So maybe we're overlooking those hidden gems sometimes.
Right. I'll admit I tend to gravitate towards the familiar companies, the ones I recognize. But hearing this, it makes you wonder, are we missing out on some real opportunities by ignoring those smaller players?
It definitely challenges that assumption that bigger companies automatically equal bigger returns, doesn't it?
For sure. But of course, there's always risk, right? Investing in a smaller company probably comes with more uncertainty.
Well, there's always a trade-off. Higher potential reward often comes with higher risk. It's about finding that balance, doing your research, and being comfortable with the level of risk you're taking on.
Right. Due diligence is key. Speaking of risk, the book also digs into this concept of burn rate.
Ah, yes, burn rate, a critical concept, especially for those of you in the startup world. Essentially tells you how quickly a startup is chewing through its cash.
It's like, how long can they keep the lights on before they need more funding?
Exactly. And a high burn rate isn't always a bad thing, but it's a major red flag if they don't have a solid plan to generate revenue anchorfully.
Because if they constantly need to raise more capital, that dilutes the value of existing shares, right?
Precisely. It's like slicing a pie into more and more pieces. Each slice might be smaller, but the pie itself, the company's overall value, hasn't necessarily grown.
Makes sense. But this burn rate concept, it's not just for startups, is it?
You're right. Understanding burn rate can be applied to any business, really. It's a way to gauge their financial sustainability, how efficiently they're using their resources. Ask yourself, are they being strategic with their spending, or are there signs of potential financial strain?
It's like checking a company's pulse. Are they healthy and growing, or are there warning signs we should be aware of?
Exactly. Now, are you ready for an idea that might seem a little counterintuitive at first?
Bring it on.
Bulkowski suggests that sometimes, not always, but sometimes, a company taking on a bit of debt can actually be a positive signal.
Now that's interesting, because we're often told that a debt-free company is the gold standard. So how does that work?
Well, he found that a shift from zero debt to a manageable level of debt can actually be a sign of smart strategic growth. Think of it this way. Sometimes you need to invest money to make money. And that might mean taking on some debt to expand operations, develop new products, or move into new markets.
So it's not about being afraid of debt altogether. It's about using it wisely as a tool for growth.
Exactly. And Bulkowski backs this up with data, showing that companies making this move from zero to manageable debt often outperform their more debt-averse counterparts. It's about finding that sweet spot where debt is a lever for growth, not an anchor weighing them down.
Okay, that's fascinating. I'm already starting to see things in a new light.
That's what Bulkowski does. He challenges those conventional assumptions and encourages us to think critically about what we're seeing in a company's financials.
Now let's talk about something everyone loves. Dividends. Those sweet, sweet cash payouts that companies give to their shareholders.
Who doesn't love a little bonus, right?
Right. Now, I've always thought a high dividend yield was a good thing, a sign of a generous company sharing its profits. But Bulkowski says there's a bit more to it than that, right?
He does. He says that while a high dividend yield might seem attractive on the surface, it's crucial to also look at the payout ratio.
Payout ratio. Okay, now you're just using fancy financial jargon to sound smart. Break it down for us. What is that?
No problem. The payout ratio tells you what percentage of a company's earnings are actually being paid out as dividends.
So a high payout ratio means they're shelling out a big chunk of their profits to shareholders, but maybe not reinvesting enough back into the business.
Precisely. A high payout ratio could be a red flag that the company isn't prioritizing future growth, or that those high dividends might not be sustainable in the long run.
So like with everything else, it's about balance, right?
Absolutely. Bulkowski highlights that finding companies with a good mix of high dividend yield and a low payout ratio could be a winning strategy.
Because it suggests that they're rewarding investors in the present while also having a solid plan for future growth and stability.
Exactly. It's a sign of a well-managed company that understands the importance of both rewarding shareholders and investing in its future.
Okay, I'm getting the hang of this. Now, throw another curveball at me. What says I read about companies cutting their dividends? That sounds like a bad thing, right?
It's definitely not something investors usually cheer about. But Bulkowski throws a wrench in the works, doesn't he?
He does. He says it's not always a bad sign. In fact, sometimes companies that cut their dividends actually end up performing better later on. How does that work?
Think of it like this. Sometimes a company needs to tighten its belt, conserve cash, and refocus its resources on areas that will drive future growth. Cutting dividends can be a tough but necessary step in that process.
It's like pruning a tree, right? You cut back some branches, in this case, the dividend payments, to allow the tree to grow stronger and healthier in the long run.
Exactly. It might seem counterintuitive, but it can be a sign that the company is making strategic moves to position itself for future success. Of course, Bulkowski doesn't sugarcoat it. He's very clear that when a company cuts its dividend, the stock price usually takes a hit.
Well, yeah, because people see it as a negative sign, right?
Of course. But he argues that if the cut is part of a smart, well-thought-out plan, the long-term benefits could very well outweigh that initial dip.
So it's all about seeing the bigger picture, understanding the why behind the decision, and not just reacting to the headline.
Exactly. Now, what I love about Bulkowski's writing is that he doesn't just throw out theory and abstract concepts. He grounds everything in real-world examples and stories.
Oh, I love a good story. Do you have one for us?
Of course. He talks about Hawaiian Electric, a utility company he followed closely for a while. And this story perfectly illustrates why it's so important to combine fundamental analysis, looking at the company's financials, with technical analysis, studying price charts and patterns to make smart trading decisions.
Okay, Hawaiian Electric. Paint the picture for me. What's the story?
So, on the surface, it seemed like a solid, stable company. They're a utility company, right? Been around for ages, providing an essential service.
Right, electricity. Pretty crucial stuff, not exactly a fly-by-night operation.
Exactly. And they offered a pretty attractive dividend yield, which initially caught Bulkowski's eye.
Makes sense. Who doesn't love a little passive income? But then, what happened?
Well, as he dug a little deeper, he started noticing some red flags. For starters, their payout ratio was pretty high. Remember, we were just talking about that.
Yeah, it's like the percentage of earnings they're paying out as dividends,
You
right?
got it. And a high payout ratio, while it might look good on paper, can sometimes mean a company isn't reinvesting enough back into the business to ensure future growth. It's like they're spending all their income and not saving anything for a rainy day.
Okay, so that's not a great sign, but it gets worse.
Yeah, it kind of does. Bulkowski discovered that Hawaiian Electric also owned a banking subsidiary.
A banking subsidiary. What does a utility company need with a bank? Seems a little off-brand.
Right, and this was particularly concerning because it exposed them to a whole other level of risk beyond the usually stable and regulated utility sector.
So they're dabbling in something they might not fully understand, and it could come back to bite them. And remember, all of this is happening during the 2008-2009 financial crisis.
Exactly. Talk about terrible timing. The market was in turmoil, banks were collapsing left and right. It was a recipe for disaster.
So what did Bulkowski do? Did he cut his losses and run?
You know, it's funny you should say that because he actually considered buying more.
Wait, seriously, he was doubling down with all those red flags waving in his face.
And it sounds crazy, right? But he saw it as a bottom fishing opportunity.
Bottom fishing. Explain that one to me. Sounds messy.
Yeah, it can be. It's basically trying to buy a stock when it's at its lowest point, hoping to ride the wave back up.
It's high risk, high reward kind of thing.
Exactly. But as Bulkowski learned the hard way, it's not always as easy as it sounds. Timing the market perfectly is notoriously difficult.
So what happened? Did he catch the bottom or did it fall out from under him?
Well, unfortunately, the stock kept falling. Even though he believed in the long-term potential of the company, those red flags were too big to ignore. Ultimately, he ended up losing nearly half of his investment in just a month.
Ouch, that's gotta hurt.
It was a tough lesson, but a valuable one. Sometimes even when you think you've done your due diligence and spotted a good deal, the market can still surprise you.
So what's the takeaway from the Hawaiian Electric saga?
I think it highlights a few crucial points. First, never underestimate the importance of understanding the broader market context. Even a fundamentally sound company can get swept up in a larger downturn.
Right, it's like trying to swim upstream in a raging river.
Exactly. Second, don't be afraid to admit when you're wrong and cut your losses. Holding on to a losing position, hoping it will magically rebound, can often lead to even bigger losses. And finally, trust your gut. If something feels off about an investment, no matter how attractive it might seem on paper, it's okay to walk away.
Solid advice. Sometimes the best trades are the ones you don't make.
Couldn't agree more. Now, are you ready to shift gears and talk about those elusive 10-baggers we touched on earlier?
Oh yeah, those stocks that increase tenfold in value. Sign me up. How does Bulkowski actually track their movements? I know he's a big believer in using charts, right?
He is. He calls them the language of the market. He believes that charts can reveal patterns and trends that you might not be able to see just by looking at raw numbers.
It's like deciphering a secret code, those squiggly lines telling a story about a stock's journey.
I love that analogy. And Bulkowski has researched and documented over 60 different chart patterns.
60. Wow, that's a lot of patterns. So it's not just a one-size-fits-all approach. Each pattern tells a different story.
Exactly. He divides them into two main categories: reversal patterns and continuation patterns.
Okay, break that down for me. What's the difference?
So as the name suggests, reversal patterns indicate a potential shift in the trend, like a U-turn on the stock market highway. Continuation patterns, on the other hand, suggest that the current trend, whether it's up or down, is likely to keep going, like a car cruising down a straight road.
So it's about anticipating those twists and turns in the road, knowing when to buckle up and when to hit the gas.
Precisely. Now imagine a stock chart where the price dips down, recovers a bit, and then dips down again to roughly the same level as the first dip. What shape does that create?
A W, is that significant?
Very much so.
Yeah.
That's a classic example of a double bottom pattern, a reversal pattern that Bulkowski highlights.
So two dips, like the stock is testing the waters before deciding to change direction.
Exactly. And this pattern often signals that the selling pressure is weakening, and a potential upward trend reversal is in the cards.
So not a guarantee, but a sign that the wind might be changing. Does he just jump in as soon as he sees a W?
That's where discipline comes in. He always emphasizes the importance of waiting for confirmation. In the case of a double bottom, that means waiting for the price to break above the peak that formed between those two dips.
It's like waiting for the stock to decisively climb that hill before you declare victory.
Precisely. It's about being patient and letting the market reveal its hand.
So no rash decisions, even when you think you've spotted a pattern. Got it. Now, what about those continuation patterns? You mentioned those earlier.
Right. One common example is the ascending triangle. Picture this. A stock's price is making higher lows, like it's gradually climbing a staircase, but it keeps bumping up against a ceiling, a resistance level it can't seem to break through.
So it's like it's gathering energy, building up momentum for a potential breakout.
Exactly. And when the price finally breaks above that resistance level with conviction, often accompanied by a surge in trading volume, it's often a sign that the upward trend is likely to continue.
Like a rocket finally breaking free of gravity. That's when he makes his move.
It can be. But again, it's not about blindly following patterns. Bulkowski emphasizes the importance of considering the broader context, the company's fundamentals, any news or events that might be impacting the stock, and the overall market sentiment before making any decisions.
So check the weather forecast, the engine, and the fuel gauge before setting sail.
Exactly. And speaking of tools, Bulkowski also uses these chart patterns to estimate potential price targets. One technique he uses is called the measured move.
Measured move? Sounds intriguing. How does that work?
It's pretty straightforward, actually. You measure the height of the pattern's formation. Let's say it's an ascending triangle that's $5 wide, and then you project that same distance from the breakout point.
So if the stock breaks out above the top of that triangle, you'd project a potential price target $5 higher.
Exactly. It gives you a sense of how far the move might go based on the pattern's characteristics.
It's like having a roadmap, giving you an idea of where you might be headed. But like any good explorer, you need to be prepared for the unexpected, right?
Absolutely. These patterns are tools, not guarantees. And Bulkowski is always quick to point out that no trading strategy works 100% of the time.
Right, because the market is constantly changing, throwing curveballs our way.
Exactly. And speaking of curveballs, there's one more pattern I want to mention, one that's particularly visually striking, the cloud bank.
Cloud bank. Okay, now that one sounds kind of ominous, like a storm brewing on the stock market horizon.
It does, doesn't it? Imagine this. You're looking at a stock chart, and you see this dense cluster of trading activity, lots of buying and selling, all crammed together, almost like a thick cloud formation. That's the cloud bank.
And what's that telling us? Is it a good thing, a bad thing, or just a weather pattern?
Well, it can be any of those things. Bulkowski's research shows that cloud banks often pop up after a big decline, a period where the market's kind of scratching its head trying to figure out what's next for the company.
So a moment of uncertainty, a pause before the next move. Do they give us any clues about which way the stock might go?
They do, but it's not always crystal clear. Bulkowski identifies different types of cloud banks, ascending, descending, inverted, each with its own personality and potential implications.
So you need a trained eye to interpret those subtle signs, like a meteorologist reading the clouds.
Exactly. It's not a standalone signal. You have to consider the company's fundamentals, the overall market trend, any recent news. It all plays a role in understanding what the cloud bank might be telling us.
It's like having an extra layer of analysis, another tool in your investor toolkit.
Precisely. For example, Bulkowski might see a bullish cloud bank forming after a company releases really strong earnings, which would confirm his suspicions that the stock is poised for a breakout.
So it reinforces what he's already seeing in the fundamentals and technicals.
Exactly. Or, on the flip side, he might see a bearish cloud bank forming after some negative news comes out, potentially signaling that further decline is on the horizon.
It's like having a heads up, a warning sign that things might be about to get bumpy.
Precisely. It's all about putting together the pieces of the puzzle, using all the information at your disposal to make the most informed decision.
Okay, so we've covered a lot of ground here. Fundamentals, technicals, chart patterns, even those mysterious cloud banks. But I gotta ask, even with all these tools and insights, isn't trading still a bit of a guessing game?
You know, that's a fair question. And I think Bulkowski would be the first to admit that no trading strategy works perfectly all the time. There's always an element of uncertainty, of risk.
Right, because the market has a mind of its own. We can try to anticipate its moves, but it often throws us curveballs.
Exactly. And that's why he emphasizes the importance of not just having a plan, but also being adaptable, being able to adjust your sails when the winds change. And you know what else? He's incredibly open about his own trading journey, both the wins and the losses.
Oh, you mean he admits to making mistakes? That's refreshing.
He does. He shares some of his most successful trades, but also some of his biggest blunders, which I think is incredibly valuable for learning. Because we all make mistakes, right? The key is to learn from them and not make the same ones over and over again.
Okay, so give me an example. Tell me about one of his winning trades.
All right, well, one that comes to mind is his trade with a company called C&O Financial Group. He managed to achieve a 90% gain in just a couple of months, so it was a pretty quick but profitable trade.
Wow, 90%. That's amazing. What did he see in CNO? What was the story there?
So he'd been following the company for a while and noticed they were going through a bit of a turnaround. Their management team was actively buying back shares, which is often a sign that they believe the stock is undervalued.
Like they're putting their money where their mouth is, betting on their own success.
Exactly. And that's always a good sign for investors. But on top of that positive fundamental indicator, Bulkowski also noticed a bullish chart pattern forming an ascending triangle.
Ah, there it is. The technicals lining up with the fundamentals.
Right. He had both sides of the equation pointing in the right direction.
Yeah.
But here's the thing. He didn't just jump in blindly. He waited for confirmation, a clear sign that the stock was ready to break out.
He was waiting for his moment to strike, like a seasoned predator.
Precisely. And that confirmation came in the form of a positive news event. Moody's, the credit rating agency, they upgraded CNO Financial's outlook to positive. And, to top it off, a well-respected brokerage firm also upgraded their rating on the stock.
Talk about a double whammy of good news.
Right. And the market reacted accordingly. The price surged on the news, and Bulkowski, being the disciplined trader that he is, rode that wave upward.
Okay, but at what point do you sell? How do you know when it's time to cash in and walk away?
Another great question. And that's often the hardest part, right? Because greed can creep in, and you start thinking maybe it'll go even higher.
Oh, I know that feeling. It's like that little voice whispering in your ear. Hold on, just a little longer.
Exactly. But Bulkowski is all about sticking to the plan. He knew that the stock had moved significantly in a short period of time and that a pullback was likely. So just a day after that initial surge, he sold his entire position, locking in a 90% gain.
Wow, talk about incredible discipline. Most people would have gotten greedy and held on, hoping for more.
It takes a lot of mental fortitude to walk away from a winning trade, especially when it seems like it's still got legs. But that's what separates the successful investors from the rest.
Okay, so you said he also talks about his losing trades. Give me an example of one of those. I'm always curious to learn from other people's mistakes.
Right. It's often where the most valuable lessons are learned. Well, one that comes to mind is a trade he made with a biotechnology company called Medivation.
Biotech, that's a whole other animal, isn't it? High risk, high reward.
Exactly. And this particular trade really highlights the challenges of investing in such a volatile and unpredictable sector.
Okay, so what drew him to Medivation in the first place?
They had a really promising drug pipeline, particularly a drug they were developing for Alzheimer's disease.
Now, that's a huge market with a ton of potential. I can see why that would be enticing.
Exactly. And Bulkowski recognized that if the drug proved successful, the stock could skyrocket.
Yeah.
But of course, there was also a big if hanging over the whole thing.
Right, because drug development is a long and risky process. There are no guarantees.
Precisely. So, while he was excited about the potential, he also acknowledged the inherent risk.
Okay, so how did he approach this particular trade? Did he go all in or dip his toes in cautiously?
He decided to start with a small position, just a small portion of his portfolio, acknowledging the higher than average risks.
So he was hedging his bets, not putting all his eggs in one basket.
Exactly. But here's where psychology comes into play. The stock started to climb, and Bulkowski, being human, started to second-guess his initial decision.
Oh, I know that feeling all too well. You start thinking, maybe I should have invested more.
Exactly. That fear of missing out, FOMO, it could be a powerful force in investing. And on the flip side, he also worried about a potential pullback, about losing the profits he'd already made.
So he was caught between greed and fear, two emotions that can really mess with your head when it comes to investing.
They really can. And unfortunately, in this case, those emotions got the better of him. He ended up selling his shares, locking in a modest profit, but missing out on significant gains the stock made later on.
That's gotta sting, knowing you could have made a lot more if you just held on.
It does. But as Bulkowski reflects on this trade, he realizes that even seasoned investors with years of experience fall prey to these emotional biases.
We're all human after all. So what's the takeaway? How do we avoid making the same mistakes?
I think the key is twofold: self-awareness and discipline. Be aware of those emotions that can cloud your judgment, fear, greed, impatience, and have systems in place to help you stay grounded and make rational decisions, even when the market is testing your resolve.
It's like having those guardrails in place, those rules you set for yourself to prevent you from veering off course.
Exactly. Whether it's setting stop-loss orders to limit your potential losses or having a predetermined selling target to take emotion out of the equation, those guardrails can be invaluable in helping you stay disciplined and make rational decisions, even when the market or your emotions get a little crazy.
This has been a fascinating deep dive. Bulkowski's book really does offer a unique perspective, a way of looking at the market that combines fundamental analysis, technical analysis, and that often overlooked element of psychology.
It's a holistic approach for sure. And I think the biggest takeaway is that successful investing is not about finding that one magic formula or predicting the future. It's about continuous learning, adapting, and honing your skills as an investor.
It's about being a student of the market, always seeking to understand its rhythms and patterns, and also being a student of yourself, understanding your own biases and tendencies.
Couldn't have said it better myself. It's a journey of self-discovery as much as it is about mastering the financial markets.
Well said. Well, folks, that's a wrap on our deep dive into Thomas Bulkowski's fundamental analysis and position trading. If you're looking for a thought-provoking and insightful read on investing, I highly recommend checking it out. Until next time, happy investing.